Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome, everyone, to this Peak Prosperity Features Voice podcast. I am your host, Chris Martenson, and it is January 9th, 2019. We scour the news. We do this for you so that you don't have to read the news, and we bring you guests that will expand your minds and deepen your understanding of the world and what the future might hold. So let me start here as the first Featured Voice podcast of 2019. Great place to start. Energy is everything. Specifically, oil energy is everything. If you walk into any store to buy any item, oil has been involved in its manufacture, its transport, its storage. Anything you want to talk about, look at it. Oil's been involved in that. Now, in the U.S., the so-called shale oil story is front and center of our own personal oil story here in the U.S., and so much depends on that story being right. And here's how that story goes right now. The U.S. is the new Saudi Arabia. We're the swing producer. The U.S. will be able to increase oil production for decades to come, and new technology is unlocking more oil all the time. But what if there's a different story that pretty much runs counter to all of that? Today, we're going to be taking a little bit of a victory lap here because the Wall Street Journal finally discovered that shale oil wells are not producing what the companies operating them said they would produce, which is what we've been saying for years, largely because we follow the work of Art Berman, who is today's Featured Voices guest. Now, Art, as you may know, is a geological consultant with 37 years of experience in petroleum exploration and production, 20 of those at Amoco, now known as BP. He's published more than 100 articles on geology, technology, and the petroleum industry during the past 5 years. Hey, he's got the chops. He's published more than 20 articles and reports on the shale gas plays, including Barnett, the Haynesville, the Fayetteville, Marcellus, Bakken, Eagle Ford shales. We'll be talking about those today. I follow him very closely at his blog, artberman.com, as well as on Twitter at AEBerman12. That's AEBerman12. You should follow him there too. Welcome, Art, and Happy New Year.
Happy New Year to you, Chris.
It's, as always, it's great to have you back on. And Art, I want to start with this somewhat validating article that appeared in the Wall Street Journal. It's on January 2nd, 2019. It had the title, Fracking's Secret Problem. Oil wells aren't producing as much as forecast. And that article opened with this stunner of a sentence, quote, "Thousands of shale wells drilled in the last 5 years are pumping less oil and gas than their owners forecast to investors, raising questions about the strength and profitability of the fracking boom that turned the U.S. into an oil superpower," end quote. Now, Art, this article seems to validate the kinds of things you've been warning about for years, and which you and I have had already several interviews on the topic of. My first questions are, what did the Wall Street Journal manage to find? Do you feel validated, and did they go far enough?
I never feel the need to be validated on this stuff because most people, even if I am validated, still don't believe it. So it's really water on a stone. But the Wall Street Journal did some research, and they got the general point that the wells are not as good as advertised, but the real what they missed was just how much farther off many of these reserves are than even the discounted reserves that they reported. And I've spoken with the author. I've known him for many years, and I just asked him. I said, "Gee, well, why didn't you send me an email or something? I would have given you a slightly different perspective, or given you maybe some." And he said, "Well, yeah, I should have." So, we'll just leave it there. But bottom line, Chris, is that 10%. If it's only 10%, it's a rounding error, and it's not that much of an issue to the average person. But I have been trying for years, for maybe a decade, to get the numbers that I independently develop to get anywhere close to the published numbers. And in most cases, if I can get to 60% or 70%, that's pretty darn good. So the gap, I think, is much more substantial. And the reason that the Wall Street Journal didn't get it more right is because they don't do any independent research. And of course, they didn't talk to me, they didn't talk to Dave Hughes, they didn't talk to people who actually do the work. And so they're getting one side of the story. But fair enough. I'm glad that they at least got the information out that maybe this isn't quite as good as we've been told.
All right. Well, so let's talk about I think the headline conclusion they came to was after, and I don't know what their methodology was. They were a little vague about exactly how they did this, but it fundamentally centered on this idea that companies in 2014, primarily when the oil price fell apart, they had to switch to some new way of keeping the capital flowing. So they went over to this thing called measuring the EUR of a well, which is an estimate of the ultimately recoverable amount of oil, it's a very simple calculation. Please don't let me oversimplify your business, but for the people listening, it's as simple as this to me. It costs money to make a hole in the ground, and then money comes back out of that hole. Now, the difference between those two is your profit or loss in this story, right? So it really matters how much money comes back out of the ground. That's largely a function of price, which you can't control. Market price is what it is, but the amount of oil that comes out times the price, that gives you your revenues in this story. So what they found was that the EURs that these companies had been promoting were maybe 10% too high. Now, that was kind of the conclusion they came to. They did note that a couple of companies in there were doing better than they had projected, and some were doing worse, and they averaged it out to 10%. But when you've run the numbers, and I've seen your data, and I look at the charts, and I can draw a straight line down a log curve and find out where it terminates, and I've discovered that those graphs, when I squint at them, seem to say that these companies are going to get half what they say out of the ground at best, sometimes less than half. So is that the kind of, when you say that they might not have, they were directionally correct, but didn't quite get it in the right magnitude, that they said maybe there's a 10% problem, you think maybe there's more of a 50-60% problem?
Yeah, very likely, Chris. And so there are really two fundamental components to understanding this problem. The first is when a company says and tells the Wall Street Journal, our average well in thus and such a play or a basin or whatever is, and they say it's, 750,000 barrels of oil equivalent. Okay, well, when they say average, I mean, the next question you have to ask is average of what? Is that really the average of all of your wells, or is that the average of 20 wells in a particularly good part of the play? And they don't tell you that. And so I seriously, I don't want to believe that they're lying. And so therefore, I do believe that the statement is true about some number of wells. But when I look at any company's wells, I look at all the wells that they've drilled since, maybe 4 years ago. So I leave out all the wells that happened in ancient history 10 years ago when supposedly they didn't know what they were doing or whatever. I'm just looking at, recent good faith efforts, and there's just no way that those numbers work out to the numbers that are stated. So it's called cherry picking. That's number one. And there's no way that a Wall Street Journal writer or independent analyst can know that, or maybe even know the right question to ask. The other piece is all these estimated ultimate recoveries, EURs, are expressed in something called BOE, barrels of oil equivalent. Okay, what the heck is I thought a barrel of oil was a barrel of oil. Well, no. You got oil and you've got gas that are produced generally at the same time. And lucky for you, because the gas is what lifts the oil to the surface. So how do you convert 1,000 cubic feet of gas to a barrel of oil? Okay, so there's the question. And so the problem that we have is that conversion is done based on energy equivalency. And so it works out to be about a 6-to-1 ratio. So 6,000 cubic feet of gas works out to be about a barrel of oil. The problem is that a barrel of oil is worth something like 20 times an MCF or 1,000 cubic feet of gas. So if you're working on a ratio of 6 and it's 20 or 25, well, you're giving yourself a huge boost, especially in a play that has a lot of gas. And the Permian Basin has a lot of gas with it. And the Eagle Ford Shale has a lot of gas with it. So just in that simple conversion, you end up with as much as a 35% artificial increase in the value aspect of the EUR. Now, don't get me wrong. This is perfectly legal to do it this way, but it's misleading as all get out. Because as you stated, the economics is calculated based, I mean, you're basing it on the price of a barrel of oil, not an MCF of gas. And so if you're inflating, a third of the value stream by a third, well, that becomes a very significant difference. So those are the two principal areas that they're cherry picking what they're saying is the average, and they're not converting gas to oil on a value basis. And those two things get you in a world of trouble.
Well, on that value basis, you might even be being generous in saying that, it's got that 35% piece. Because I'll tell you why. I was just in preparing for this interview, I just went and looked at some more recent satellite photos taken at night, and I still see lots and lots of gas flaring in Bakken and the Eagle Ford and the Permian basins. They're very bright lights on the night satellite photos. So in many cases, this gas, BOE or not, it's not even economic in any way because it's just being burnt off.
Not to mention, in fact, putting a lot of methane in the atmosphere, which is not good for the planet. And so why are they allowed to do that? I mean, they it's not like it's obviously not covert. I mean, you can see it from any satellite photo. And if you're in the area, you can hardly miss it. And so they're being allowed to do it by the state regulatory agencies. And they're being allowed to do it, I think, for a pretty simple reason. And that is that the state wants the tax revenue from the production. And so they're saying, look, we'll flare the gas, we'll produce the oil. And as we produce the oil, we'll pay you your production taxes and all that kind of stuff. And so it's a win-win, right? And the regulatory agencies, although I'm sure there are lots of conscientious worker level people who are saying, wait a minute, this isn't right. But the agency has the discretion to do that. And in some places like the Bakken, they're starting to tighten things up. Public outcry has gotten great enough that they're starting to be more restrictive. But starting to and being so are two different things. But in the Permian, I don't think they're anywhere close to becoming more restrictive. So it's a money issue, as it always is.
Well, this level of flaring, if we were at war and, we absolutely had to get the oil out of the ground as fast as possible, I maybe could understand it. But it looks like a war zone to me. It's like it's an emergency. What is the emergency to get this out of the ground as fast as possible? We can't even wait to tie in some gas pipelines so that we can get economic value, some sort of work value out of that.
Is a capital expense. It's not cheap. I mean, it's going to cost you, $1 million or so, maybe $500,000, depending on how far you have to lay a pipeline between your wellhead and wherever that pipeline is. And you're probably going to have to go out and buy a compressor to create enough pressure to enter into the pipeline. So all that adds up. It's not a prohibitive cost, but it sure is a cost, and it isn't free. But to your point, yeah, what is the big hurry, considering that the world is once again back in an oversupply of oil? So the hurry is to produce more oil, to create more oil that we don't need, and to press the price even lower, ensuring that the companies are going to make even less money than they were when the Wall Street Journal, when Bradley Olson published his article a month ago.
Right.
And what do we all that oil? We export a lot of it. We can't use it.
And I want to talk about why we can't use it, but I will say, for me, this becomes an issue of generational integrity. I can only imagine people in 50 years looking back saying, "You did what? You did what with those the last great oil deposits that existed in those source rocks?" It just doesn't feel like it's a very. It might make good capital sense, but it doesn't make. It's not very longitudinal thinking in terms of how we're using this. Is this the best possible use for this amazing bequeathment of energy that somehow got left for us to use? So that's how I look. I'm a conservationist at heart. I just think that if you don't have to ruin an area, don't. Let
me be real direct for you then, since you're being nice about it. It's not only a dumb idea, it's a terrible idea.
Thank you.
Okay.
All right. And so let me... And I'm going to chip away a little further here. So a couple pieces from this article, this Wall Street Journal article, here they said, to harken back to one thing you said earlier so I can close this loop up, they said, quote, "One reason thousands of early shale wells aren't meeting expectations is that many companies extrapolated how much they would produce from small clusters of prolific initial wells, and some also excluded their worst performing wells from the calculations, which is akin to eliminating strikeouts when projecting a baseball player's batting average." So to me, that's a conscientious effort to deceive right there. There's no other way I can look at that as anybody who understands data, who understands analysis. Certainly the people in the oil companies know that if you take your 10 best wells and exclude your 10 worst wells and then tell everybody that's how you're doing on average, you're fibbing.
It's and so it's misleading at best, and it's probably borderline fraud at worst. But whatever it isn't honest.
Yeah.
But the way they're choosing to do it probably is legal. That they've probably been very careful in vetting the actual statements made. So somewhere there's an asterisk that leads to an appendix that tells you, in fact, that what you just said is right, that we're only including these wells and we're excluding those wells. So that's been my experience with it all. But the issue that I think is so hard for people to grasp, and certainly was for me, is the fact that many of these companies, not just oil companies, are not in business to make money. They're in business to get money. Okay. And so whether or not they turn a profit is apparently not of great concern to the investors that give them money. So the fear isn't that we don't make money. The fear is that our story doesn't get people to write checks, doesn't get private equity to give us infusions to keep the thing going. And don't get me wrong, Chris. I mean, investors are not stupid, but they understand what I think you and I understand, which is that for all of the dismissal that goes on publicly of peak oil right now, saying how could peak oil have possibly been right when we've got more oil than we ever had before? I'll tell you what, smart money never, ever doubted the concept of peak oil. And the reason they're putting their money in these companies is because they're long on oil. And they know what you know and what I know, and that is it's only a matter of a very short time, maybe a few years, maybe less, maybe more, before oil prices go to the moon. And then the investment will prove to be an incredibly lucrative one.
Yeah, and so I want to get to that because this is what I'm really trying to do with outreach and educational pieces like this, is help people understand really what's going on and where we are in this story. Because, for instance, Ford Motor Company just last year in 2018 made the decision that they were going to scrap sedans and focus on their more lucrative light truck sales because that's where they make more money. And clearly they had to be factoring. They know as well as any company out there that rising oil prices kill demand for the exact kind of vehicle that they were going to be focusing on. So they bought on some strategic level. They said, looks like oil's here forever. The United States is new Saudi Arabia. Let's go over to the EIA, the experts on this. Hey, look at this. They're projecting that oil and gas output is going to rise through the year 2050 in the United States. Hey, that's long enough for our planning cycle. right?
You got it. That's it.
So let me ask you this. How much of those projections by the EIA are depending on these projections by the companies at root? Where do they get their data from? How do they build their ground up analysis that says, here's how much oil we think we're going to be having across the future decades?
I actually think that the EIA has the resources available to them. And I say this because I've actually seen reports that they put out that don't get a lot of publicity that totally support the kinds of points that I've been making over the years. So, but they use some very sophisticated forward modeling. Now, the most important thing to understand here is that if there are any geologists or other geoscientists in the EIA, I don't know where they are. So these are smart people that are good at economics and business and accounting and whatever, and they're running models. So the models are somewhat unconstrained by geological reality. But I think they start in a reasonable place. And what they do then is they look at projection trends. And if you're looking at something like the Permian Basin, well, you can project the production very, very conservatively and get to, rising production until 2040 or 2045, and then it just starts to flatten off a little bit, and voila, you've got 10 times the proved reserves that people have claimed. And the question I ask is, well, that's great, guys, but where are the reserves going to come from? Oh, well, don't worry about that. They will come. If we build it, they will come. That's where I think those forecasts are in error. So I don't think the EIA is I don't think they're amateurs. I think they're trying to do a good job, but I believe that they are overwhelmed by the empirical data of production increase, and then they say, well, okay, maybe the proved reserves aren't there, but there's so many probable reserves, and they look at technically recoverable resource estimates, and they say, there's just so much out here, it doesn't matter. We're good. That's what I think. Are they part of a government strategy to promote U.S. energy dominance? Well, they're part of the government, so I don't see how they couldn't in some way be part of that push. But whether it's conspiratorial, I don't think so.
Well, it's the conspiracy, such as if it's like that, is just a conspiracy of bad data. So, I'm really a big believer in this idea that there are acceptable ranges of thinking, and they get put out and sort of adopted by a culture. They could be completely wrong, but still it's what most reasonable people think. So reasonable people at Ford looked forward many years and said, hey, we're going with light trucks here, right? And you and I would look at the data very differently and say, hold on, look at the lack of global investment, look at where we really are and all this, and maybe you should want to put some caution to that particular strategy. So people can disagree. That's fine. The conspiracy of bad ideas and bad data for me would center on this idea that the companies have been overstating how much they've got, and that's the base data that feeds into the longer term projections of what the EIA is up to. Because when David Hughes does it, he says, well, you got tier 1, you got tier 2, you got tier 3 areas. There's only so many you can put in per section. There's only so many benches or strata that you can drill into. We add it all up. There's room for 49,000 more wells in the Bakken, or whatever the number is, and you can get your hand around that. And each of those different tiers and benches has its own output profiles, and everything in that. We can argue: could you get 3 per section, or is it 2? Are there 3 strata that are worth drilling, or is it 4? We can argue about that, but if your EURs on a well basis are off by 100%, that's the biggest source of error you could possibly have.
And the number of wells that you can, the well spacing is the source of an awful lot of error also. That the companies will say, we can ultimately drill these wells on, say 40-acre spacing, when I look at it, or Dave looks at it, or any kind of professional journal does and say, no, we don't think so. We think it's, at most it's probably 90 or 100. So they're overestimating because the wells are going to interfere. You can drill as many wells as you want. There's no problem. The problem becomes when the wells are too close together, they start stealing production from the nearby well. So you have two wells where only one was needed. And so, but investors, they like the idea of more wells because that says, a company can say, well, we've got 75 years of locations. Oh, well, that sounds like growth to me. But yeah, Dave is completely right. He's got a really good handle on the way this works. And so there are many, but here's the bottom line. The bottom line for me is that despite the fact I'm a geologist and I pay attention to fundamentals and details, the most important factor in the whole thing is capital. And if the money continues to flow, then the oil will also continue to flow. Now, it may cost an ungodly amount of money per barrel, but we got enough oil in there that and enough technology that at some price, yeah, we can meet those goals. And so the evidence to date is that there doesn't seem to be any hesitation in the willingness of people to pour capital into this deal. So that is the number one concern.
Yeah, so let me ask you about that because, a couple months back I interviewed Dr. Scott Tinker of the Bureau of Economic Geology down your way in Texas, who was of the opinion that he was very bullish, very optimistic. He was of the opinion that shale recoveries only had to improve by 1% or 2%. So for people who don't know, when we're drilling into these shale rocks, we're drilling into basically it's like the chalkboard you'd see in a school. It's hard stuff, and we were getting just a very low percentage recovery of the oil in place because guess what? It's pretty hard to pull a liquid out of a solid like that. So anyway, he was of the opinion that if we could get just 1% or 2% more out of the rock, then we would have twice as much oil in these things, and there's already a lot there. So he was really optimistic. He thought future technology was going to meet us right when we need it when we got out there. What are your thoughts about that view?
Right. Well, first of all, Scott Tinker is a friend, and I respect him as a colleague as well. Scott has a much more optimistic view of oil and resources and reserves than I do, and I don't see myself as a pessimist. But so that's just where I'll start with this. Look, before shale plays came into existence, just when we had regular conventional oil, people have known for 100 years that we leave something like 2/3 of the oil in the rock. We just can't get it out. It's a surface tension. It's a capillary pressure problem. And so if we could only figure out a way to get another 1% or 2% out of conventional reservoirs, we'd have enough oil to last for a couple of more centuries. All right. So that idea, enhanced oil recovery, that has been around for longer than I've been alive. And you know what the net results of all that optimism have been? It's worked in a few places, and it generally hasn't done a thing to prolong the life of conventional oil supplies, which is why we're into shale. So again, not to in any way disparage Scott's viewpoint, but let's balance it. The balance is okay. If you believe that, then show me where it's worked with enhanced oil recovery, because I'll show you that, again, there have been some success stories, but on balance, it hasn't done a thing to reverse the depletion of existing fields. But the second question is, yeah, the technology may be there, but what does it cost? What does it cost to get that additional 1%, 2%, or 3% out? And that's the part that you never hear. Nobody even wants to talk about it. And I don't know what that's going to cost. All I can say is it's going to cost a lot. I promise you that. And the third thing I will add is, for as much as, I'm a scientist, all right? So technology is paramount to me. But I think and I argue all the time, Americans in particular place way too much faith and confidence in technology that's going to come along and save our asses that doesn't even exist yet. Forget about what it costs. I mean, Elon Musk is going to move us to Mars. Forget about the fact we can't live on Mars, but really, really, I mean, is that the kind of future we want? That technology will solve every problem, including saving us from the destruction of our own planet? I mean, this is Buck Rogers kind of stuff. I just don't see it, Chris. I mean, I gave a presentation, actually, the last time I physically saw Scott Tinker. I was up at an energy conference in Dallas, and the laser pointer crapped out on me. It stopped working. Okay. So they bought me a new one, and that worked for a while, and then the batteries went out, and they replaced the batteries. And I went through three laser pointers in one presentation. Now, this is really pretty primitive technology, and we can't even get a damn laser pointer to work consistently through a 20-minute talk, but we're going to figure out a technology that's going to get all this extra oil out and save the planet. I wouldn't count on it. I'm a technology guy, but I think we have to know the limits of technology and the timeline of that technology to develop, to be commercialized, and et cetera. And let's just be very honest and optimistic. We're talking decades, okay? And guys like you and me worry about there may not be decades of energy left. There may not be decades of atmosphere or temperature on the planet left that we have that luxury of time. I hope we do. I hope everything I'm telling you right now for the last 20 minutes is wrong. Mm-hmm. As a scientist and what I think is an honest broker, I got to tell you what I think is the truth. And I'm telling you what I think is the truth.
Well, and I appreciate that. I love the truth as well. And the reason that I spend so much time wanting to educate people about this, look, I don't think, Art, that everybody needs to be a full-on geologist, but since so much hinges on this particular story and getting it right. So let's imagine, okay, the EIA is right. We don't have to worry about it by 2050. We're still finding more and it's just flowing out of the ground, like they say. But what if you and I are right? What if it turns out that the Federal Reserve and the other central banks have overdone it? They've blown their third credit cycle, the first one in 2000, the second in 2008. Here we are on the third, the largest. It's global. It's amazing. When it breaks, guess what? Getting capital is going to be hard to come by. So regardless of the price of oil, we might find that there's just not enough capital to throw another $250 to $500 billion at the shale space, and the next thing you know, the United States finds itself needing to import more and more and more on a year-over-year basis, and now we're up against all the other countries that want to import more and more and more for their own purposes, and that's a very different future. So we ought to have at least something. A few chips on red when all the rest are stacked on black in this story if we're playing roulette here. But it feels to me like everything's just all geared towards we have one story and that's it. It's the shale story. It's going to work and there can't be, it will work and all of that. So this is why I think it's important for people to understand. We've been using some terms here. Maybe we should just back up for just a second. Art, explain for our listeners, please, the difference between an oil or a gas reservoir in a conventional sense and a source rock or this stuff we're calling shale.
Sure. So the source rock is the black, goopy, crummy stuff, the organic accumulation of all the dead algae and plankton and stuff in the oceans that ultimately gets converted into oil through being buried, put under pressure, and put into a higher temperature environment. It takes a long time, but think of it as a refining process. You're cooking up a batch of stew. Mm-hmm. You start with a lot of raw things that either you wouldn't want to eat or you can't chew because they're too hard. You put it in water, you boil crap out of it, and eventually it gets soft, and eventually, it turns into something edible. Well, I mean, that's a simplistic way to think about it. But so the source rocks are that. They're the pot. They're the kitchen. That's where you cook the raw materials to produce the stew, which is oil. Now, the first thing the oil wants to do once it's generated is to get out of Dodge. It wants it has buoyancy, it has gas in it, and it's got force and pressure. It wants to break out of that shale, which it does. It fractures it. It's a natural frack job, if you will, and it finds its way as quickly as it can into a lower pressure environment, which usually means moving up vertically. And if it can find a nice sandstone or limestone along the way that has big holes in it, well, that's an even lower pressure kind of environment, and it just scoots itself right into that sandstone and migrates upward towards the surface until it runs up against a trap where it can't move any farther. That's called an oil field. Okay, so that's how you find conventional oil. You find it in a nice sandstone or a limestone that has a lot of pore space, that's all filled with oil and gas and some water. Now, what's left behind, I mean, if you want to take everything out of the stew pot, what are you going to do with it? Well, what most people do is they either throw it in the trash or they throw it in the compost, because it doesn't have any more use. That's the shale. That's what's left in the shale play. And so what our technology and our lack of better opportunities, frankly, because of depletion, what we've done is we figured out, well, the oil did its own natural fracturing to get out, but we can do an even better job. We can bust it up even more, and we're going to free what's left, the residual. We're going to free a certain percentage of what couldn't get out on its own, and we're going to get it out for ourselves. And that's the play. That's the shale play right there in its simplest terms.
So excellent description. Thank you for that. And so if these ancient marine shales, that's the source rock, that's the kitchen, that's where this stuff's getting cooked. This is the critical part. What do we turn to? What do we drill after those are gone?
I think we're kind of done. I mean, I'm a petroleum geologist, and if there is, there are all kinds of pie in the sky sorts of things. I mean, you can talk about gas hydrates, frozen methane, at 30,000 feet and, off Japan. But that's not liquid petroleum. That's methane. There's some crazy ideas about how there's actual petroleum generated in the mantle of the earth. I don't think anybody really believes there's very much of that. But so as based on current understanding of the earth and how petroleum is created, I think we're done.
Yep. And that's important because, people, it seems like there's always more and more stuff being announced or discovered or something like that. In fact, if the EIA and USGS have both come out with things. I think it was just this past November. Let me look up my notes here. Yeah, November 2018, the United States Geological Survey, the USGS, the big news splash. They came out with the announcement that the Wolfcamp and Bone Springs formations alone, just two formations, two stacked layers down there in the Permian, contained some 46 billion barrels of oil, 281 trillion cubic feet of natural gas, 20 billion barrels of natural gas liquids. Holy smokes, Art, huge numbers. First, how much did those estimates rely on the stuff we've been talking about before? But I think it's people think, oh my gosh, we just discovered that. We didn't know about that before. So this is new stuff.
No, it hasn't been discovered. This is, this is a resource, or a resource hasn't been discovered yet. So this is the USGS's estimate of how much is in place, how many molecules of oil and gas and natural gas liquids exist in that rock that they believe could be technically brought to the surface. Now, cost is not an issue. Some of that might be at 50,000 feet. Some of it might be, under a national park or under a city and therefore never accessible, but it's technically recoverable. Mm-hmm. And it might cost $1,000 a barrel, but that's okay because that's not the purpose of that particular analysis. So it hasn't been discovered, but let's ignore all of those sort of annoying details. I looked at that exact same report And the USGS is always very good about giving you a table somewhere in there, and they're going to tell you exactly what the drainage area of each one of the wells that they modeled was, and what the average recovery EUR, if you will, is going to be. And so I did a calculation, which I believe that the survey would agree with. And to access that 46 billion barrels and everything that goes along with it required, if I remember correctly, 311,000 wells at 10 million apiece. Yeah. And using the average EUR, the mean, I guess, they give you ranges, using the mean, which I can't remember what it was, but it was something like, 170,000 barrels of oil equivalent. Well, run that through an economics program, and the break-even price on that great new discovery that isn't a discovery was $135 a barrel.
As a break-even. No return. No return to capital yet.
Okay, so that's the, and again, I'm not in any way criticizing the U.S. Geological Survey. They're doing what they get paid to do, which is to estimate, basically undiscovered resources. And they give you all the data. They gave me all the data to very quickly come up with the answers that I just gave to you. But where in the world do you ever see those kind of, oh, well, by the way, excuse me, but it's going to take, a third of a million wells at $10 million a piece, and it's not going to be economic at triple current oil prices. Whoops.
Yeah, whoops. We just have to find 3 trillion laying about and have at it. It'll be fine.
Well, we have to have a very urgent need for it, don't we?
Yeah. And of course, all the things that the damages to the road, the amount of water, do we have that much sand? A lot of questions about all of that too. So there might be some other limiting factors in all of that. And instead, it feels like the conversation really ought to be, look, there's stuff here. I'm not saying we shouldn't go after it, but we should understand its limits. And the question is, how big is it, and what are we going to do with it? Because that's what every company does, that's worth its salt. They have a strategic plan, and a strategy consists of, where am I going? How am I going to get there? What's the vision? What are my resources? So the country ought to be saying, where do we want to be in the year 2050? What kind of world do we want our kids to inhabit? Oh, and how much energy do we have to get there? And put those two pieces together. If there's energy left over, go ahead, sell F-150s or whatever you feel is best, right? But in the meantime, I what I'm trying to sort of argue against here and convince people of is that there's a bit of a propaganda, there's a bit of a campaign out there to convince us that we basically have no decisions to make and that oil's unlimited. And oh, by the way, when we do get out to the future, we'll figure something out, right? And I'm not sure that's a good strategy. I'll go further. It's a bad strategy. And I'd like to help people understand that.
It's a terrible strategy. And you say a bit of propaganda. I'd say there's a whole lot of propaganda. That is the dominant message that one gets from paying attention to even the more reliable press. And the reason for that is that most of the people who report that information are honest, good, intelligent people who have never worked a day of their life in the oil and gas business. So, on some level, they know not of what they speak, or at least the details. The so-called analysts, the people that work for, you name it, Goldman Sachs or Deutsche Bank, again, most of those, they're smart, they're great guys, they read a lot, almost without exception. They've never worked a day of their life in the oil and gas business. So how do you know? How do you know that the inputs, that the costs that a company, how do you know if it's right? You never had to write a check for a well.
Mm-hmm.
You know. Now again, I'm not disputing that they're smart and they learn fast, but there's just nothing. If you're talking about our country's energy security and future, don't you think it'd be kind of helpful to ask some people, not the CEO of ExxonMobil, but the average Joe who works at ExxonMobil or me, who actually does the work, and say, what do you think about this? I mean, does this make much sense to you? And I think what I hear when I go around and give talks is that, first of all, nobody actually disputes the data that I show them. They say, oh, Berman doesn't know what he's talking about, or he's a peak oil guy, and we know what those guys are like, and et cetera, et cetera. But nobody has ever disputed the data that I put out there. You know, the economics tables, the EURs. Nobody's ever said, no, you're wrong. So it's cognitive dissonance. They don't want to hear it. They've made an unconscious decision that that's not the message that I want to hear. I want to hear the good news. Well, guys like you depress me.
Because that's not what I wanted to hear. Well, I'll tell you, you've given me cognitive dissonance because on the one hand, I read in the news about the United States continuing to put enormous pressure on Germany to some recent success, because apparently some German politicians are now questioning whether they want to scrap the Nord Stream 2 gas pipeline from Russia to bring natural gas in under the theory that the U.S. is going to supply Germany with liquefied natural gas. My dissonance comes from you, Art, because I go over to your Twitter feed and I go to your website and I look at your natural gas storage charts for the United States, and they're really kind of concerning to me because we don't have that much in storage compared to a 5-year average, and I can't make those two pieces fit together. Either we're swimming in gas and we have enough to supply Germany forever, or we don't even have enough for our own uses. There's a big gap between those two stories. What's going on here?
Yeah, so we've never produced more natural gas than we are producing right now, and the growth of natural gas production has never been higher than it has been in the last 2 years, and nor has the amount of natural gas consumption and export been higher. So what you have to do when you're looking at these numbers, and I don't expect anybody except a giant nerd like me to do it, is to come up with a gross supply. So say, all right, this is everything we're producing, and this is the rate that consumption is increasing every year, and this is how much we're exporting. What are our net imports, or imports minus exports? And what you then find is that our real supply, our gross supply, has probably peaked and it's flat, and it's going to start going down. And the reason for that is that, again, we go back to this phenomenon of the frat boys that find something good, whether it's shale gas or tight oil, and they can't keep their pants on, and they overproduce it. Whoops, what are we going to do now? We just drove our price down. Oh, I got a good idea. Let's export it. Let's send it out to the rest of the world. That'll relieve the pressure and allow us to continue wasting the natural resources we have and not making any kind of profits for our investors. So the natural gas situation is quite simple. And that is, if we were just doing what we ordinarily have done for the last however long, which is to say produce and import the rest, we'd be fine. But we are exporting a lot, and because we're displacing coal, partly because the natural gas is cheaper, but also because we don't as a society, we've decided that coal is probably not a great thing to base our future on. So we're increasingly using more natural gas than coal to generate electric power. Electric power is the future of the country. All right, that means more natural gas. So that's the story. And so we went into this winter with the lowest amount of gas in storage that we've ever had. I mean, totally unprecedented. And we got a little bit of cold weather in November and December, and gas prices went higher than they've been in 5 years. Now things are back down to normal because we've had some warm weather, but you're playing with fire. That's the point. And that's the message I've been putting out there. If you guys want to live on the edge and be prepared to, in some localities in the Northeast and New England, you want to pay $50 an MCF for a little while, be my guest. I live in Texas. That never happens here. It's your choice. That's what happens when you don't have enough put away. It's like your bank account. You decide, well, I don't need to save anything because I'm 25 years old and I never get sick. And then all of a sudden you get hit by a car and suddenly you got some big medical expenses and you didn't save anything. What do? Well, you borrow or you don't fix it or whatever. You put yourself at risk. You're playing with fire, and that's what we're doing with natural gas. But again, why do we do that? Because of the assumption that we got so much, we could give it away. I mean, they are giving it away in the Permian Basin. They're selling it for almost nothing just to get it out of here so we can produce the good stuff, which is the oil. So I see what amounts to me to be a truce management of our natural resources in this country. And I say that as a guy who spent his whole life in the oil and gas business, for crying out loud.
Yeah.
I'm not on a Greenpeace ship somewhere, being militant about getting rid of the fossil fuel industry. That's not who I am. And if it bothers me, then other people ought to be bothered. Not because I'm such a great authority, but because I know stuff that the average guy doesn't. I'm on the inside.
Well, all very well said, and I think I'm hearkening back to what you said, that many of these oil companies are actually in the business of obtaining money, not making money, and they haven't made money for a very long time, which has been, my clue that something is not right here in this story. And of course, you dig under it a little bit, and you find a lot of this data that we've been talking about here today, that these companies have been claiming they're going to get 1 million barrels of oil equivalent BOE out of a well, but maybe it's half that actually. The Wall Street Journal's finally come onto that just a tiny bit. I certainly hope people in Germany think long and hard and avail themselves of statistics before they would do away with access to a natural gas pipeline from Russia that might provide them with reliable, cheap gas for the next 50, 60 years. For some hype. Look at that stuff very carefully, Germany. That's my free tip to you today. So with all of that, Art, it's just, again, you've been on this story the whole way through. I do wish they had consulted with you a little bit more on this, maybe in a future article, but you've been all over this story, and I've certainly been tracking it. So the minute I saw that article, I thought, well, finally, at least, they're getting to this a little bit. And I too know a lot of wonderful people in the gas business and oil business. Nothing to say about that, but the finances and the way this has been run, and the hype, the propaganda, the way Wall Street has been peddling this story has been annoying to me, because it's intellectually dishonest, and it falls apart so easily. Who are the people pouring hundreds of billions into this industry? They're smart people. I've been confused by all of that. So. With all of that, Art, thank you so much for your time today. For people listening, his website, artberman.com. You can check out wonderful. He's got his presentations that are just amazing. Also, at AEBerman12 at Twitter. I follow a lot of great charts there that you're putting up with all of that. So, Art, hey, thanks so much for your time today. And it's great talking with you first here in 2019.
Always a pleasure, Chris. Thanks a lot.